Another day in the stock market where we were range bound for the majority of the day. We had the 10 o'clock sell-off as we usually get. We are getting a glaring sell signal that I'm going to walk through. We've seen this twice, and twice it's worked in the past 12 months, so it's something that we definitely have to pay attention to. Also, we have to understand what's going on with the breadth of the market. But these lines are starting to get a little more defined and more hanging in there. We did see massive rotation once again today, and we are seeing retail step back in. What does that mean? Several names are setting up bull flags. Let's get into it. Hey everybody, welcome back. In today's video, we'll be going through all the news, all the updates, what to look for tomorrow with GDP, several stocks that are setting up, and key levels on the indexes. I'd like to go through two specific graphs that you're going to find extremely important. You can see our line right up here. We're going to start with the simple 1 hour chart futures market. You can see right up here where we try to get through that 4080 level and we were unable to. Tried again. So right now we are hitting lower highs. Now you have GDP tomorrow. And we did have a very nice day today, but I think we should take it in context. If we drill out on this, very simply look at this and expand it out. Look at the past 2 days. Well, all we really did was get to the point where you came in the night before and you were down. And then you kind of sitting here around that 2 o'clock level, you start to move up, right? You start rallying a little bit. You could kind of get a sense of how they've just been whipsawing us all over the place coming into Wednesday. And then, oh, by the way, now we're going to go up. So it's just been pretty much a roller coaster in the futures market and for the indexes. But the roller coaster is really taking place. It's like a tempest in a teapot. And what I mean by that is if you really look at the range, and let's zoom out on here for a moment and just let's go to a 4 hour chart. I think that'll give us the best perspective. And what I want to show you is that if you go back to October, where have we really gone? Let's clean up all our lines and just pop these in real quick, and you can see where I'm going with this. Very clean, right? Just pop that line in. Where have we really gone since the beginning of the year? And if you kind of take a look back, we're hitting the same spots over and over again. It's like Groundhog Day. And that frustration is getting to people. The one thing, if you take nothing away from today's video, take this away. You are in a trading market. People think that they are in this breakaway market. They are buying these breakouts. And all that's happening is they are selling right into you. So the moment that you pop over, institutions, algos, high frequency traders, they are selling right into the rips and they are buying the dips. It's the strategy I've been doing since 2023 this year, and it's working really well. Just support and resistance. I did a whole video on it. And actually, because of your comments, I'm going to do another video on a short we did today that was with the stock and options. So I do appreciate the comments. I was apprehensive to show more of my trades or things that I've done just because I didn't like the idea of showing dollar amounts. But based upon the comments, it seems like it's not as cheesy as I think it is. So you can always comment on it and tell me it is cheesy. I would appreciate it. So you can see these levels right here and you can see how we're playing out, right? So what we need to focus on is what is going to get us out of this. Now, the data in front of you, this is from MarketWatch, and we're just going to dig into a couple pieces, some very simple pieces. We have an overheated economy still, ladies and gentlemen, and a lot of the investment banks still think that they're going to raise rates in May. I don't feel that way, but it doesn't matter. My feelings don't make me money. I learned that a long time ago. But if you look at Tuesday, Wednesday, Thursday, we have some data that's came out, and that data we should be paying attention to. It's pretty glaring. So for example, you have a 104.2 reading on consumer confidence. This is one of the highest readings that we've had. Now we're out here at 1007 for an estimate coming in at 1042. We've got stocks like Lululemon crushing earnings. 103.40 was the previous. Now, you fast forward to the next day, we wound up selling down on that number. Barr testifies in front of the Senate on banks. We all know how those testimonies go. And then Wednesday, 10 a.m., we're supposed to be looking for a loss in pending U.S. home sales, and we're at 0.8%. Now, I've been talking about housing for a long time here. We are short over 5 million houses. And the majority, I think it's somewhere near 50% of the houses that do have a mortgage are under 3%. So that supply probably does not come to the market. I think this is somewhat of a misnomer and we just don't have supply of housing right now, but that does drive the cost up. This is something that is going to raise everybody's antenna. Now, it is very difficult to believe that the U.S. consumer confidence coming in at pretty much a new reading. When you start looking at this, we don't want to be beating previous readings. We just don't want to do that, let alone crushing the estimate by 4% on consumer confidence. It's interesting to see how confident people are considering what's going on in the banking industry. Now we have earnings, banking earnings start in April, and we can address that in next week's video. But if we take a look at pending home sales, right? And then we come in tomorrow and we're looking at GDP. Well, if you were looking at consumer confidence and you were looking at pending U.S. home sales, you are going to be in a position where you're going to want to be short. A matter of fact, after consumer confidence, we know that the market came in short, right? Then they rally us up a little bit today, take us through certain levels right into GDP at 830. That is really scary to me because if you're long going into GDP, this could be vicious tomorrow. Now, fast forward to Friday, because if that wasn't enough, and if these Fed speakers are not enough, then we have Friday coming in and we've got core PCE. These numbers are going to be glaring. Now, this is the number one indicator that they're looking for. And the last thing that we want to see here is anything year over year high or core PCE kicking up. We don't want to see anything like that. So now you know what we don't want to see. The issue is, what do we want to see? Well, I like the action that I saw today. My problem with the action is twofold. Now, this is the Nasdaq in front of us with a 4-hour chart, and you can see our level right here. That becomes a battleground, and then it looks like we're flipping that battleground, doesn't it? And we can see the trend line right here. We can pop that in, but what we're looking for is we're looking for signs that what we're doing is right, okay, or that what we're doing makes sense. Now I can put this here. That's not how I draw my trend lines. I draw my trend lines based upon the amount of points that something hits. It just seems to me to work better for me and the way that I trade. You should draw your trend lines the way that you're comfortable drawing yours. Now, remember, technical analysis is not only a science, but to me, it's also an art. So you see how you're holding in that level right here, this little area. You can easily come back down here and still maintain that 2023 trend. But you're starting to hit pure bonk level up here, right? So you're starting to hit a level right at this point, right back here in September. And if we go all the way back to September and we look at this, well, that's 6 months. So that's definitely something we want to look at, right? Let's see why that's not working. There we go. So bonk, bonk, bonk. Now, could you flip this tomorrow? Absolutely. And the reason I'm showing you this on a 4-hour chart is because what I'm going to show you next about what I don't like. What I do like is, to me, this is a flagpole. This is a flag, and we're sitting to break up. So could we break out here? Absolutely, you could. And if you look at some of the key stocks, you could, but there are some glaring signs here that we have some issues. These are notes from the newsletter. If you do not get the newsletter, I suggest you do. Link is in description. Now, as of yesterday, the MACD was starting to curl and come down. Today, it's straightening out a little bit. And you are seeing a renewed interest in where the lines are getting wider. That is what the histogram actually measures. This histogram measures the width of these two lines. That's why the crosses, you see the histogram change. That's why red to green, green to red on the histogram is so important. But here we are, and we can see our levels right here, right? So, well, this looks good. I have no volume. If you come down here and you take a look at your volume, I'm going to pull this up right here for a moment so that we can see this particular section. My volume has fallen off a cliff the past 4 or 5 days. That is because of GDP tomorrow and because of PCE and the placement. There's another reason why the volume has completely imploded. The volume is imploding because the 2-year is sitting right here at, let's call it 410 to make the math simple. Now, the one thing that benefited the banking industry, specifically regional banks, was this sell-off. Their portfolios, they are long bonds. If bonds drop, then their portfolio goes, or bond yields drop, their portfolio goes up in value. So you can see why that would be significant. So then we drop down, come to this trough level, which was 350. Well, we've given back 50 basis points already. The question is why? The reason is because people are concerned that this Fed may still raise rates in May. Now, tomorrow's GDP and Friday's PCE is going to give us more clarity on that. We covered this in greater detail on Saturday, but it's really important to me that you get this. So here we are on the 2-year. The 2-year right now is the vehicle of choice if you are a regional bank. You're not going to go out there and buy the 10-year because that's what happened to people and that's why they're getting crushed. Now, and they're crushed also because of the leverage. Now, here you have Fed funds. Fed funds is at 4.57. If you borrow between these two, if I borrow at Fed funds window, right, and I want to go out there and buy assets so then I can lend, so I'm going to lose money on the purchase of the bonds. Then on top of losing money on the purchase, I'm going to get a depositor that's going to come in and I'm going to have to pay them interest. How's that going to go? It's not going to go very well. So right now we are in a very weird situation. I went through this Saturday, and this has probably happened 6 or 7 times in the past 40 years. It's extremely rare, and it means that the bank and bond market are in distress. The only way this has resolved since the 1980 loan crisis, which is as far back as the example that I gave on Saturday, every single time there was some kind of intervention by the Fed. Whether it's rates or injection of capital, there's always some kind of intervention. Always. Now, we've also had the beautiful opportunity to learn something new, that the bond market actually has a VIX, just like the stock market. And I know a lot of people wish they didn't have to learn this, but we do right now. So we can see the rally up, and we can see everybody saying, well, when this starts to drop, that should mean that the S&P should go up. And there is an inverse relation to this, that the tighter that this gets means the market's more stable, the S&P should go higher. You can actually flip this and then just overlay it. It's pretty standard stuff. I'm not sure that I'm going to go along with that, but I will point out what I think is fairly obvious, and I'm going to go back a little further here. If you went back and you looked at the June, September area, November, and you see us starting to creep up on bond insurance, you will remember that that is the high on the S&P. So it is possible that the low is put in because we are here. Is that a possibility? We certainly need to be aware of it, everyone. Now, as we are zooming in here, there are a couple key things that we need to focus on. This bond volatility index is now higher than the pandemic. For us to sit there and say that this is a spot where this is normal and we're not facing any kind of crisis and don't worry about it is just laughable. Okay? You're at more distress in the bond market, more pressure to have some kind of protection than you were during a pandemic. That's where you're at right now. If you put this into context, when I go back, the only spot that I have found that was anywhere near this, and it was only up there for a couple more weeks where you've hit this level, the only spot was the great financial crisis. So they're your guides right now. So to say that there's not something wrong in the bond market, we pointed out the 2-year Fed funds, we pointed out that flip, and we're pointing this out right now. Now, I want to clarify this. We analyze, right? So as I stated, you can invert this and say, as we're here, right, that can mark the bottom of the market. Now, if you go back and take a look at the S&P 2 years ago, you were about a week or two away from that being the bottom in the market, in the stock market. And you can go and look at those dates. I'll do it really quick right here, and you can just see that level right in here, and you can see how we're acting, right? You see it? So it was about 2 weeks later, and then all of a sudden, wham. And I want to point this out. It just doesn't happen because it's there. So in other words, we were talking about 2 weeks in, right? Well, here's that 2 weeks in. When you're looking at March 9th, here's 2 weeks later. So to say that, oh, I'm just going to go out and buy because moves hitting highs, it doesn't work that way. You would have gotten crushed here doing that. It would have taken you 2 full weeks, 3 to just even break even. So it doesn't work that way. It's one data point that we have to look at, and we have other data points as well. But I do think that it's worth noting that these signals, this is when those signals are going off. And if we want to get really into it and go back, we can go back into when the bond market hit the all-time high, which was right in here. It was right at that level. Let me put that in there. It was right at this level when we had the all-time high on the move. Now, since then, you had about 5 or 6 months of still selling down. So it's not a be-all, end-all where you would sit there and go, oh, thank God, they're really scared out here and they're buying tons of insurance on their bond portfolio. That's great news. Let's buy stocks. No. But it does mean that we could be getting to some kind of fervor. Now, I want to point out 2 things, but I'm going to link all this together. Now, my goal during the weekdays is to pack the information in and get more specific on the weekend. So that is why I'm talking fast and covering a lot of ground. If it's too fast, let me know. Please put it in the comments. I do read all the comments and I do respond. Now, we are looking at the BBB, AAA corporate bond yield spread. What someone is willing to pay for one BBB versus what you're paying for AAA. What's the difference? Well, let's just say you're currently at 1%, which you currently are at 1%. If BBB is paying 7, then AAA is paying 6, right? If you think about it that way, because this is better than this. All right. So we understand how to utilize that. Now we look at these levels and we realize coming straight across that the highest we were during 2016 was what? 1.9 or almost a 2% spread. During the pandemic, we were at almost a 3, it looks like up here. Let me see if we can get that reading. 2.7% spread on corporate bond yields. Where are you now? So when you try to wrap your noodle around this and you look at the actual market where we had the great financial crisis and you realize that you had a 4% at the high, it was a 4% difference. So in other words, if this was 10% on BBB, these were paying 6, right? And then you go out and you zoom in and go, what the heck is going on? Why isn't the bond market worried? I don't have an answer to that. I don't have an answer to why we're not spiking. Why is the move spiking to pandemic levels, second highest reading we've ever had, and the bond yield spread on corporates is acting like it's just another Tuesday? I don't have an answer, but it's keeping me up, and it's something that I'm trying to wrap my head around. Again, if you have something that I should be looking at, I'm all ears. I'd like to hear it in the comments. Now, technicals are technicals and they can change on a dime, especially in this market, as we're very well aware. And we're going to drop this and we're just going to put this into a daily. And I want to put this into a daily so we can remember that there's no volume here. If this was any other chart and you were looking at it, I would be very comfortable. What I see happening is I see a lot of gamesmanship where they have gapped you down, formed a hammer, and then they flip the hammer by the end of the day. And now they just have shorts trapped going in the GDP. And shorts are looking at it going, just get me out of the way. And I'll walk you through why I think that. In front of us is the smart money, dumb money confidence spread. Now we can see the spread down here and how it widened. And we can see how we got over this line and how it started coming down. I want to point this out because we talked about it 2 weeks ago and I'm always asked to follow up. The fact that you're still up here and staying up here is something that we must be paying attention to. When you are up here, over the course of the next year, you outperform on the S&P. That does not mean you don't go up or down, as you can see by these markings right here, right? You could have said, oh, I'm going to buy right here, and that would have gotten you in here, and then you could see how we sold down, right? It's not a one-stop shop. It's one data point. Now, that spread is determined by the difference between smart money, which we don't say, and dumb money, which we don't say. We refer to it as institutions and retail. Now, we can see institutions seem to have lost their taste for the market. They are starting to slow down, and we can see that pretty clearly here, right? And who's stepping in? Retail. Now, is that good or bad? The only thing that I think is bad about it is retail cannot outbuy institutions. They very simply can't do it. And if you look at inflows, hedge funds are slowing down, but ETFs are buying the Netflix and the Metas and the Googles. It's the ETFs right now that picked up the slack. Why you're starting to see the hedge funds slow down. I'm not sure how this ends. I know how it ended before, and that's why I'm not ruling it out. This is when, quote, dumb money, or what we say, retail, got involved. This is when institutions sold. See the spread? Institutions sold the whole way down, while retail did exceptionally well. So retail called the bottom, institutions not so much. So when you look at this, they got to buy into the upswing where institutions were buying the entire time into the downswing, right? Very different. So I don't know how this plays out, but I think it's a very interesting dynamic that we need to be aware of. And it does have my antenna up because institutions are looking at this and going, you know, we had a nice run. Let's see how this goes. And retail saying, you know what, I need to get in. I need to get in now. And they're putting money in inflows. I'm not sure this is the time I want to see retail getting real heavy ahead of a GDP number, Fed, bank earnings, PCE Friday. Not sure that that's the predominantly smart move right now. Now in front of us are DeMark indicators, and I just want to point out a couple things here that are glaring. This is an S, and it just gives you a sell signal. It is one data point. It is not a be-all, end-all by any stretch of the imagination. And you can see where the 13 fired, and then you can see where this sell signal becomes executable. And I do pay attention to these. I don't act on them, but as I said earlier, it's one data point. This data point I'm paying attention to because I'm going into a lot of data tomorrow. And this talks about exhaustion. That's what DeMark focuses on, exhaustion. You can see the buys here and how he nailed a couple of them, but I'm not going to get into the whole system right now. I might actually do a video on it. If you think that's a good idea, comment below. But if you take a look here and you see how this is setting up, you have your sell signal in here, right? That's because of exhaustion. So is it possible that that's a sell signal? Well, if you go back and look at the last couple peaks, this is what is troubling to me. He's called it here and he called the peak. Now that one people could say, well, that's fairly easy to call because that's the 200-day moving average. Anyone could have called that. Why didn't he call it here? It's not perfect. It's a system. It's a process. Here you are again, peak, peak. So if I look at this and I look back at the past 2 years and he said sell 4 times, how's his track record so far? Okay, so I need to pay attention to this. I can't just ignore it. It doesn't change my trading, but it is one data point that you need to be aware of. Now in front of us is the Nasdaq with the AD line, its advanced decline line. And I'm just going to point out some very simple things. You do not want to be in a position where your AD line is off. You want your AD, meaning your advanced decline line, you want it to be following. If it's not following, what you're going to get, right, is real simple. You're going to get divergences. And when you see divergences, you're going to want to pay attention to them, right? That's something that you could see pretty much here. So in other words, you have the Nasdaq right up here. And then if you were to look at the divergence, well, you would see that right here, right? So you would just come straight down and look at it from there. Let's put that line in from there so we could see it, right? And then you can kind of see that divergence right there and how we fall off a cliff, right? And it works both ways. It'll work on the positive divergence as well. Whereas you can see right here that you're not hitting a new low on your advanced decline line. And then at the same time, you're hitting a low right here, right? And you can see that really clearly right there, how you hit a new low, but the AD line didn't. So that was a clear sign that you had a what? Positive divergence. And I could point out a couple more of these, but the bottom line with it is this. Is it exact? No, but there are some in here that are glaring. And this one to me is pretty glaring. So we are sitting up here and the breadth of the market and the advanced decline line has fallen off a cliff. And that is troubling to me. So when I look at all these data points and I put them all together, that is troubling. And that's troubling. I've got low volume. I've got very light breadth. I've got sell signals. And I've got institutions that are slowing down, but ETFs are picking up because retail's running it. That's why my antenna's up, not to mention GDP, PCE, and some of the other data points we went over. And I want to be clear about this. I'm looking at these charts too. Apple looks beautiful. It's really hard to knock that name, right? It's very difficult to look at Apple and not think it looks great right now. You're seeing this flag and breakout on Netflix. I get it. I'm looking at the same exact chart. It looks beautiful. And if I'm just trading the technicals, these could work. You can see how you reversed on NVIDIA today, right? Across the board, things are working. Things are holding, right? You saw Meta push higher, okay? So I get it. But my concern is a possible rug pull with that kind of breadth and that kind of volume going into GDP, going into PCE on Friday. I would rather be sure, because if we're sure, then I've got nothing but time and I've got the wind at my back. And that's what I'm looking for. Hope this was helpful. Any questions, as always, reach out. Have a good night, everybody.